Good afternoon, everyone. My name is Robin Dolezal. Today is November 3rd. With me, as always, is Dan Nintel and Alex Pars. How are you guys?
Good.
Hey, fellas.
Hey, guys. Hey, everybody. We're with Ironwood Financial, and I hope you two are doing very well. Did you notice it's getting colder as the day goes on?
Yeah.
Haven't got our first snow yet, though.
No, but I'm supposed to take the kiddos camping this weekend, and I feel like it's going to be a cold one. Well, as we approach our next holiday, which is what, Thanksgiving. Dan, are you having a big family come out this year?
You know, that's yet to be determined.
Fair enough.
Yeah, it's going to be an interesting year. We don't know who's all coming down, but hopefully some family will, like usual, keep the tradition going.
Yeah, great. I know I've got my brother coming into town, which is great. He's usually here only once every few years, so it'll be good to see him.
That's fun.
Yeah. How about you, Alex?
Nope, just me and the cats.
I love it. I love it. All right, well, let's get started. Dano, let's start with you. Let's talk about the market a little bit. What are your thoughts?
The market had an interesting pivot yesterday with Chairman Powell's realities. They did exactly what they told us they were going to do back in September, but then his remarks afterwards came by a little bit less than being enthralled about. The market was up decently and then just fell off pretty quickly. And today was a modestly down day. It wasn't anything overly exciting, but reality is people keep asking me about, so why is it good for them to keep raising interest rates? And that's a hard one because, at the same time, all we're hearing about is how just the economy's on fire. There's 1.7 available jobs for every one person that's unemployed right now. I mean, if you want to work, there's plenty of jobs. We get the comment, well, gosh, nobody came back to work after COVID. We're actually at pre-pandemic levels of people working. So the economy is doing really, really well. The problem is when the economy is doing well, people have money to spend. And if there aren't goods to buy, they overpay for them, which is driving this inflation. And I'm certain Alex will spend more time on inflation. But what you have to understand is there's a large majority of people out there that live on a fixed income. There's a large majority of retirees that live on Social Security as their only form of income and their only asset. And when you're seeing the cost of goods go up, those people actually get inflated out of their lifestyle. And so the Fed has a mandate, try to keep employment down and try to keep inflation down. So they keep raising interest rates. And, you keep hearing Congress, politicians coming out today yelling at Chairman Powell saying, it seems to me you're hurting the masses. Why are you artificially trying to keep the stock market down? And I don't know if that's necessarily the goal, but reality is if the stock market's on fire, people feel wealthy and the inflation won't stop. So it's this really weird situation where the economy is good, but that's driving inflation, which is making the Fed react. And yesterday they said we may react a little bit longer than we were hoping. And the market got a little depressed by it. So market was down today. October was a pretty good month, but remember this, in my opinion, and I say this quite a bit in our meetings, we haven't seen bond yields like this since the tech boom of 1999 and 2000. And so for those people about to retire, it is pretty exciting to see a bond that's paying, if you blend them out, with the high quality and some high yields, you can easily get 6.5%, 7.5%, and you're not going out very far. So this reset, the great reset, as I've said in these meetings a couple of times, was needed. I mean, the stock market PEs were out of whack, and now they're actually in line. It's just unfortunately, until the Fed gives us the idea that they're not going to keep raising interest rates, we're not certain where the market's going to go. Mm-hmm. That being said, most of the big banks are continuing to say that 3,500 in the S&P potentially and most possibly was the bottom. Who knows if that's the case or not. Unfortunately, they're saying we might touch it a couple more times, meaning the volatility will continue. And with all the hubbub about yesterday's comments, all it really did is most people have been pretty consistent of we'll start to see the market climb out of this doldrum here end of second quarter. Now they're saying beginning of third. So even though everyone's kind of depressed on the financial shows right now, not really anything's changed. So, I would say keep your head up. I think the market's pretty close to the bottom. We know this. The quantitative tightening is far closer to the end than it is the beginning. And bond yields are pretty exciting right now.
It was interesting yesterday when they announced the 3/4 point hike, which we all, anticipated, but the market was happy with that, right?
Yeah,
I think the Dow was up 300 points. But then you're right. Once you started talking, I think Mark was like, wait a second.
Yeah,
he seems pretty tired.
Alex, change?
Yeah,
Did
go
they
ahead.
change the terminal rate to 5 from 4, or what did they do?
You know, I'm not sure that he specified. I read an article this morning that said people were assuming the terminal rate now would be about 5, which is about 0.5% higher than we thought, 2 days ago. And so that means, a couple more rate hikes. The general message of the meeting was longer and slower. So, we've been doing these 3/4 rate hikes for several months now, and we were kind of anticipating either 0.5 point or 3/4 of a point in December, probably still the case. And then we were hoping for a 1/4 point next year, and that's it. So what it sounded like he was saying, and this is the first time I've heard him say this in a while, which is, the time lag between monetary policy and its effects in the economy. He said that, back in March, and then I haven't heard him say that in months. So now he acknowledged that's the case, and that we really don't know if all the effects of all the moves they've made already. So they still haven't, fully affected the economy. So it's time potentially to slow down. But he didn't want to go out there and tell people it's time to party. So he said, yeah, we're going to slow down, but if we need to, we're going to go higher than we anticipated. And that's the message the market took, was this is going to stay high for longer than we hoped. And again, I like to use the example of a home. And, you said, why does raising interest rates slow down the economy? Imagine you bought a house in 2019 for 200 grand. Okay, in 2020, you refinanced it to 3%. So now you're paying $1,200 a month in mortgage, plus taxes and insurance, right? So now it's 2022 and your house is worth 350. Great. Okay, well, if you decide I want a slightly nicer home, well, you maybe pay 500,000, right? What's your mortgage look like now? 4,000? You're not going to move from a $1,200 mortgage to a $4,000 mortgage. So what does that mean? That means you're not going to move. If you're not going to move, the realtor doesn't get paid, the mortgage broker doesn't get paid, the movers don't get paid, the painters, the appliance people, the landscape people, all those things that you do when you move doesn't happen because you don't move. And that all those people who provide those services, the jobs start to dry up. So that's why raising interest rates slows down the economy. And we've definitely seen that. Home inventories, car inventories are going up very quickly, and houses have started to sit on the market, whereas before they were selling in minutes. So it's working. The question is, how long do we need to keep it that high before we can go back to the good old days of low rates and cheap money? And the answer is, we need to get rid of 3 or 4 million unfilled jobs. And so that's the number that we've been watching. And we're down, 1.5 million from the peak of available jobs, but we're still 3 or 4 million away from where we need to be. And so unfortunately, that means we'll probably have to raise or keep rates higher again for longer than we originally hoped.
So, and I know he's watching this as well, but what are some of the numbers that you've been watching that come out, whether it's weekly, monthly, as data points?
I watch the job openings number. To me, that's the most important. Again, it's, if there's 10 million jobs out there and, there's 1 million unemployed people, what does that mean? That means that there's people, employers are beating down the doors of any applicants. And so if I'm working for $15 an hour, I can jump ship and work for $17 an hour tomorrow. Well, the employer that was paying me 15 now has to pay someone else 18 to attract them. And that's what creates the inflation. So we need to get back to the point where I can't find a new job like that. And if I can't find a new job like that, then I need to worry about keeping my existing job. And that's when unemployment starts to go up. So, there's another unemployment number coming out soon, I think tomorrow, maybe.
Friday. Yeah, tomorrow.
Yeah. And people are hoping it goes up. I don't know how it goes up with 10.5 million unfilled jobs. If you want a job, you can get a job.
Right.
There's no reason to be on unemployment right now. So that number to me is a lagging indicator. It's not a leading indicator. The leading indicator is how many jobs are out there. So
I wanted to go back to Dano. You had mentioned about bond yields. We've had a lot of people who say they've been sitting on cash. They're not ready to go back into the market just yet. And I've already forgotten what these treasuries are paying. What are they paying now for a short term?
Well, and again, it's it's a weird time because, and I'm going to answer your question in a long run out way, but right now we're in a position where good news is bad for the market and we're looking for bad news. And it feels terrible, really. I mean, it's like we root for bad things to happen to the economy. You know, as Powell said, we need people to lose their jobs. It's kind of unfortunate considering people are doing pretty well right now. But with that happening, there's a few little indicators. People realize that this isn't going on forever. You know, so if we thought this is going on forever, the yield curve would go straight in a linear way, kind of from the bottom left to the bottom right, if you will. But the yield curve is actually kind of inversed or even flat. So right now, a 3-month treasury is paying right at 4%. I think it's like 4.01. But the problem is there's no benefit to going out. If you want to buy a 6-month, you're getting that same 4.01. You want to buy a year, it actually goes down to 3.95. So right now, short term, and we've had a lot of people do that, saying, you know, I've got some money that I'm going to be using. I don't want to take much risk or any risk in theory. If you believe in the dollar, I want to buy a treasury, and we've been buying 3 months with the idea of just keep rolling them, you know. But it's interesting because we keep talking about inflation, right?
Well, hold on, Dan, before you jump into that, I want to throw some numbers into that, which is if you're sitting on $100,000, okay, and you buy a 3-month treasury, you're going to make $1,000 in the next 3 months.
Yep.
Okay, that is not something that we could have been able to say for decades. So that is a true, you know, actual yield, you know, safe money that we can earn. And that's pretty impressive. So again, if you're sitting on any sort of cash, this is, you know, it's almost a no-brainer. There's no risk to it. It's one of the few investments we can say that. It's the US Treasury. They're going to pay you back. They run out of money, they just turn on the printer.
Right.
Okay. So I wouldn't worry about that at all. And it's a great way while you sit here, if you're worried about whatever, you know, you're going to earn 1% every 3 months.
I was looking.
What were you going to say?
You want to do I was looking at some 2024 bonds, so going out 14, 15 months. And if you split that between AAA and some triple Bs, you're getting almost 6.2% for 18 months as an annual rate. It's pretty amazing. But again, why are rates up? Because remember that the Fed has to raise interest rates to try to squash inflation. Now, I also realize that that's also why some of our portfolios are unhappy with bonds. But remember, if a bond is a contract, we know what we're going to get paid. We know what we buy it at. We know it's going to mature at. So I'm excited about the next year or so to see the bond yields stay where they're at, and also our bonds mature to get all that principal paper losses back. And then it all comes back to inflation. So Alex, I mean, so China's talking about getting rid of their zero COVID policy, where they're going to shut the entire world down. Right now, I've heard they're starting to open up factories full, you know, gangbusters again. There's about 6 or 7 container ships sitting out in the Pacific, which is down from 110 at the peak. And then yesterday, we've had a lot of people ask us about I-bonds. You know, go to treasurydirect.com. You can only buy $10,000 per social security number, but it was paying 9.62%. And they just came out and said, what do we think for the next 12 months? And they dropped it to 6.89. So, I mean, going out more than just a couple of months, the world is actually fairly optimistic. It's just kind of bummed out by the fact that Powell talked yesterday and said we're going to extend it a little bit longer.
Yeah, the only problem and the only thing that anyone cares about in the stock market and the financial markets is what's the Fed going to do. And so we're all sitting there. I heard this on Bloomberg. I thought it was pretty funny. It's kind of like, you know, we're all in the back seat saying, are we there yet? Are we there yet? Are we there yet? And we keep thinking we're there, and we're not. So it's
that's a really good analogy.
It's going to happen. You know, the stock market is very excited to see, you know, the light at the end of the tunnel. And I think it's going to go gangbusters when that happens. But we keep getting these data points that say, no, not quite yet. Come back in 6 weeks. And that's what we got yesterday. It was, no, not quite yet. Come back in 6 weeks. And so, again, it's not like they raised their guidance a ton. They raised their guidance by about 1% in September. That's a big move. People are saying they raised their guidance by about 0.5% this time as the terminal rates. But if we're talking the terminal rate is sometime next year, you know, that could be 3 quarter-point raises throughout the entirety of 2023. You know, that's the effect, the same as what we got yesterday.
Right.
So,
I mean, reality is if they did 50 basis points December, like we were all hoping, And then we would probably think they had get a hope for like 4.75, and now they're saying 5. I mean, it's really not much different.
No. And that's
So-
why we saw mortgage rates come down today.
Yeah, they went down.
Yeah.
I guess the $1 million question, Alex, is we know what's going to happen with the bonds that we've owned for years, and they're going to mature, and we're going to be pretty happy about it. We're happy about the yields on our bonds. We're excited for people that need to take income from their portfolio. With our equity portfolios, at this point, I still believe we're closer to the bottom than we are at top. And
Oh, absolutely.
So I
I
mean,
mean,
it's just the thought process is going to take a little longer to heal.
The PE ratios still look wonderful. That doesn't mean they couldn't look better, but they still look really good. And corporate profits so far have been resilient, even through the tightening. You know, there was a funny example with Chipotle where they came out and they said, you know, this increased labor cost is really getting us, really eating into their bottom line. But we charge so much more that's, you know, we had record profits.
Right.
So corporate profits are doing fine. And as long as that continues, again, all we need is for that Fed pivot everyone's talking about, which is, okay, we're going to stop hitting you with a hammer and we're just going to start poking you.
Yeah, you're right. Corporate profits the last couple of weeks have actually been pretty good.
Yeah.
Okay, well, Alice, you want to throw up our disclosure slide, folks? If you have any questions, obviously don't hesitate to ask. You can find us at ironwoodfinancial.com, or you can reach us at 888-271-4646. Gentlemen, it is always great to see you guys. We'll do this again shortly. Hope you guys have a great rest of the week.
All right, take care.
Thanks, guys.